Welcome to this explainer. Today we're going to tear down a dense corporate earnings report, but we're doing it to understand the pulsing heartbeat of the broader macroeconomy. Let's dive right in. Move over AI because today we're talking about actual physical trains, a true 200-year-old titan of industry. Rather than getting bogged down in spreadsheets, we're going to use this financial data to take the real-time temperature of the American supply chain.
So, to kick things off, I want you to think about the massive scale of heavy industry. Seriously, just take a guess in your head right now. Exactly how much revenue do you think a physical steel and wood railroad can generate in a single quarter? It's so easy to obsess over software companies and tech giants, but the physical movement of goods, that remains the absolute bedrock of global commerce.
To answer that question, we are pulling directly from the official CSX Form 10Q and their earnings release from July 22, 2026. The data inside this report perfectly illustrates how this physical Internet of Goods is pumping through the economy right now. Because this isn't just about trains, is it? It's about the chemicals, agriculture, consumer products, and raw materials that literally make modern life possible, all navigating a massive 20,000 route-mile network. To make this giant wall of financial data digestible, we're going to break it down into 5 parts. 1. The Q2 headline numbers. 2. Where the growth lives. 3. Rewarding the shareholders. 4. Looking under the hood. And 5. What it all means. Okay, Section 1. The Q2 headline numbers. Let's look at the massive scale of this operation and answer that first question about the sheer financial size of it all. In just 90 days, CSX generated a record quarterly revenue of $3.94 billion. That represents a massive 10% year-over-year increase compared to 2025. I mean, just sit with that number for a second. We're talking about nearly $4 billion changing hands in 3 months, strictly to move things from point A to point B. This was driven by a combination of increased fuel surcharge revenues, higher volumes, and stronger pricing across all their lines: merchandise, intermodal, coal, you name it. But what's really impressive here is the efficiency. Look, it's one thing to grow revenue. It's an entirely different beast to translate that into actual income. And they totally nailed it. They grew operating income from $1.28 billion in the second quarter of 2025 to a staggering $1.51 billion in Q2 2026. That's a 17% jump. In their net earnings, those followed right along, hitting an unbelievable $1 billion for the quarter. Now, this wasn't an accident or some lucky pricing fluke. CEO Steve Angel highlighted that this performance was directly tied to their personnel successfully managing substantial volume growth on the ground. He made it clear that their focus on safety and productivity is what allowed them to deliver this kind of financial win, setting a really strong foundation to carry that momentum into the second half of the year. Moving on to Section 2, where the growth lives. Let's unpack this physical Internet of Goods and see exactly where this volume is coming from as a reliable economic indicator. The sheer physical scale of this growth is just incredible to see. We are looking at a 6% jump in total volume. That means 1.68 million units moved across their network in a single quarter, up from 1.58 million the year prior. And when you remember that every single unit is a massive container or a train car full of economic lifeblood, well, a 6% increase means hundreds of thousands of additional tons of goods are suddenly in motion. And this isn't just some isolated growth in a quirky sector. The report explicitly notes that this is a broad-based market expansion. But the absolute standout here is a 9% surge in intermodal growth. If you aren't familiar, intermodal is fascinating. It's the system where shipping containers seamlessly transfer between rail and trucks without the freight itself ever being unpacked. So a 9% spike here means consumer products, retail goods, and manufacturing components are just flying off the docks and onto the rails at a highly accelerated pace. Because they successfully charged higher pricing and managed all this increased volume efficiently, their operating margin expanded by 240 basis points to 38.3%. What does that mean in plain English? It means they're keeping a significantly larger slice of every single dollar they earn. When you combine higher volume with higher margins in a capital-heavy business like a railroad, boom, you get the billion-dollar net earnings we saw earlier. That brings us to Section 3. Rewarding the shareholders. Let's talk capital returns. When a traditional heavy industry business makes $1 billion in 90 days, where does the cash actually go? The answer is right back to the owners. Over the first 6 months of 2026, CSX aggressively bought back 12 million of its own shares on the open market. They spent $506 million doing this, at an average price of around $42 a share. By reducing the number of outstanding shares, they're effectively making every remaining share slightly more valuable. That's over $500 million returned to shareholders in just half a year. But they aren't just buying back stock. They're also making sure the people running the company are highly motivated to keep that stock price climbing. They rolled out a new long-term incentive plan for management covering 2026 through 2028, and it's based entirely on two metrics. 60% of it is tied to return on invested capital, meaning how efficiently management uses cash to generate more cash. The other 40% is based on their total shareholder return relative to their competitors in the S&P 500 industrials. They have completely aligned the executives' paychecks with the shareholders' portfolios. Now add in an 8% dividend increase earlier in the year, plus a brand new repurchase authorization they got from the board of directors in May. Add it all up, and the company now sits on a jaw-dropping $5.7 billion in total capacity just to keep buying back its own stock. That is a massive war chest dedicated strictly to capital returns. Let's pivot to Section 4. Looking under the hood. It's not all counting billions, right? We have to acknowledge the costs of doing business and the gritty risks of running an industrial empire.
Running a railroad means you're dealing with hazardous materials, massive heavy machinery, and grueling physical labor. Because of this, CSX has to sit on a huge $482 million in reserves strictly to handle casualties and environmental issues. That $482 million includes $163 million for personal injury claims, $148 million for environmental reserves, and $58 million for occupational issues like past exposure to solvents, diesel fumes, or asbestos. This is the very real cost of doing business in heavy industry.
And this perfectly illustrates the long-tail risks of operating a 200-year-old business. It's a fascinating, if sobering fact hidden in the financial notes. CSX is currently identified as a potentially responsible party at approximately 210 environmentally impaired sites under the federal Superfund law. Some of these issues stem from discontinued operations, or even situations where old predecessors sent hazardous materials to recycling facilities owned by completely different companies. It just proves that when you move the economy's heavy materials for centuries, you take on decades of environmental responsibility. Finally, Section 5. What it all means. Let's check the economic pulse and extract the key takeaways from all these billions of dollars in revenue and massive reserves. Why does all this matter to you?
Here's the absolute crucial point. Railroad performance is basically a real-time proxy for macroeconomic momentum. Tech stocks might reflect our future hopes, but railroads, they reflect present-day reality. When a massive logistical network like CSX reports double-digit revenue growth, a 17% jump in operating income, and higher unit volumes across the board, it is a flashing green light. It signals that the broader macroeconomic engine is healthy, factories are producing, and consumer demand is still incredibly robust.
As we wrap up this explainer, I want to leave you with this provocative thought. If the physical internet of the economy is pumping 6% more volume through its veins right now at record financial efficiency, those goods are destined for store shelves, construction sites, and manufacturing plants. Where do you think all those goods are heading next? And which sectors of the economy are about to catch the wave of this massive physical momentum? Thanks for joining me as we broke down these numbers. Keep your eyes on the rails to see where the economy goes from here.